Why do we follow economic rules that directly hurt the majority of people if people were the ones who created them? Here's one example. Inflation has been plaguing our nation for 3 long years. But why don't we just get rid of it? If you removed man from this planet, would inflation still exist? No, of course not. So then inflation is man-made. So why not just get rid of it? I'll ask you another question. Why does an interest rate exist? When you take out a mortgage, it is assumed that you will pay an interest rate. But what even is that? And why do you need to? Why not just a flat fee to borrow that money? Because they said so? Who is they? Now, a beginner in economics or finance may not have an answer to these questions at all, and an intermediate might give you what they think is a very clear answer. We pay an interest rate because time has value and because a bank needs to be compensated for the risk of loaning that money. And you would definitely ace a beginner or even an intermediate economics class with that answer. But why? Dig deeper. Why? Why does time have a monetary value in the first place? Why is time worth more when the Federal Reserve raises interest rates and seemingly worth less when they lower them? Shouldn't time be worth what time is worth? And one of the greatest modern economic principles of all, why must the economy keep growing year after year? Why can't the economy just stabilize? 100 million loaves of bread, 10 million cars sold, and 500 In-N-Out locations. Why does next year have to be 110 million loaves of bread and 11 million cars sold and an extra 10 In-N-Out spots? Well, there are two answers to this question. The first is what I was taught in school. It is the traditional right answer. And the second answer is perhaps more sinister. It would even maybe lie on the fringes of conspiracy. So, which is the right answer? I don't know, but I'll give you both and I'll let you decide. So, let's get started. The first answer is the right answer, the one taught in school, the one that I learned in my finance classes. And that answer has everything to do with scarcity, population growth, and efficiency of capital. We live on a grain of sand, floating through the vastness of space. And on this grain of sand, on this rock, there are limited resources. And everything we have, phones, cars, computers, it was all made with things already here, which in and of itself is crazy that we basically have supercomputers that we made from rocks. But I digress. I have a finance degree, not a physics degree. The point is scarcity. Everything is limited. Wars have been fought over water rights precisely because of this scarcity. So let's answer the question, why does time have value through that lens? In theory, the value of time is there for two main reasons: to cover the lender's cost of inflation and to cover the lender's cost of risk. The lender is taking a risk that that money will be worth less when it's returned, if it's returned at all. But why not compensate this risk with like a flat fee? Efficiency of capital. One of the cornerstones of modern finance is efficiency of capital. In fact, finance can be defined as the movement of capital from inefficient locations to efficient ones. And by adding a value to time, aka an interest rate, especially when it comes to business loans, you are theoretically weeding out the businesses or the ideas that cannot overcome the bare minimum, which is making a return higher than the value of time. Now, all this sounds good in theory. You are only funding the best businesses, and you are weeding out those that know they cannot be profitable above the bare minimum. But what defines the best businesses? Profitable ones? In this scenario, yes. Which means it is not defined as the best businesses for the people, or the businesses that are best for their employees, but instead the businesses that are best for their owners and their lenders. Now, you could make the argument that instead of getting a loan, a business can acquire funding through equity, and that is absolutely the case. But the time value of money still exists in that scenario. And in fact, the burden is usually larger, not smaller, because equity is usually taking a higher risk. So because of this scarcity and limited resources, a cost component is added to time in order to compel businesses to actually do something with that money. Or instead, it would have been better somewhere else. Efficiency of capital. That argument, though, starts to break down when you realize that most bank loans are created out of thin air. Literally, when you go get a loan from a bank and you're approved, the bank literally just poofs that money into your account. Now, yes, the new asset to you is balanced by the new liability, the loan, and the opposite is true for the bank. Their new asset, the money that you owe them, is balanced by the money that they gave you. So it all cancels out, except the interest. The interest is real money, and it comes from your pocket into theirs. It is your expense and their profit. So for the bank, an interest rate is really a profit mechanism, so long that that rate is above inflation. Which begs the question, does scarcity of resources apply to money when it is in fact not scarce? Why then the interest rate? To cover inflation, of course. Which is a great time to now try and answer the question, why does inflation even exist? Once again, from the perspective of the right answer taught in finance classes. Well, because of limited resources. You see, as population grows, demand for all things from the basics, like water, to the luxuries, like smartphones, increases. That alone in itself will cause price inflation. But price inflation is not the same thing as monetary inflation. Monetary inflation is the devaluation of currency from the increase in supply of said currency. Now, monetary inflation usually causes price inflation, although price inflation can also be a symptom of more demand or less supply. A perfect example of this is right now in the real estate market. Yes, the devaluation of the dollar has absolutely contributed, but even without that, the lack of supply in the face of more demand has risen prices. But I digress once again. Why does the Federal Reserve voluntarily decrease the value of the US dollar by increasing its supply, thus creating inflation? Well, classically, to facilitate the growth of the economy, to keep up with the growth of population. More people, more demand. More demand, more needed supply. And in order to fund the work required to create more supply, more money is needed. But even in this scenario, why not print just enough money to counter the growth in demand by just the right amount of supply? Well, classically, again, you'd be taught that the reason is to push the economy to grow through spending. Remember, if consumers do not spend, companies cannot make money, and thus cannot increase salaries, and the economy cannot grow. So by instituting inflation, preferably close to the Federal Reserve's target rate of 2%, consumers, then knowing that things will be more expensive in the future, do not put off purchasing, thus creating economic growth. Now, on a tangent, you know what's funny? Guess where the famous 2% target rate even came from? Does it come from an economic study, or an economic experiment from a research university, or anything else based on facts or data that 2% is the correct amount of inflation? No, it doesn't. It comes from a seemingly random comment from a television interview with Roger Douglas, who was New Zealand's finance minister in 1988.
They talked about the need to wind back protection. They pointed out that that was one of the reasons why we have high inflation. The government has moved.
So not from experiments or studies or anything scientific or data-based, but from a television interview. Anyways, this yearly inflation thus continues the cycle or flow of money from consumers to businesses, then to employees through salaries, and to investors through dividends, who are both, in turn, at some point consumers, thus continuing the cycle all over again, keeping the money flowing, keeping the economy turning, and fighting off a downward spiral of deflation. That is your classic answer. But is it the real answer? Let's find out. The other answer is a little more ominous, and it has to do with, honestly, government mismanagement and corporate greed. Now first, let's talk about inflation, because it benefits both the government and corporations, and their investors and their billionaire owners. Then we will talk about interest rates. Not just interest rates though, but their direct relationship and correlation to to inflation to create ideal environments for these very same people. So let's start with billionaires and let's use an example to highlight this. Let's say your company just went public and you own $1 billion worth of its stock. You, my friend, just became a billionaire. Now, most likely, you're a billionaire on paper, not in liquid cash, because most of your net worth is in its stock. Now, you could sell that billion in shares, but you would then owe hundreds of millions of dollars in taxes and probably crash your own company's stock price. So, how do you live a billionaire's lifestyle while simultaneously avoiding hundreds of millions of dollars in taxes? You do it, of course, by taking a page out of the billionaire's classic playbook. You borrow money and you use your stock as collateral. Let's say you borrow $500 million against your $1 billion of stock on a 30-year loan. And for the next 10 years, you set aside $300 million to make the loan repayments. And you use the remaining $200 million of that to buy real estate all over the world, to buy a few nice cars and a jet and invest in some other businesses. And honestly, just live a lavish lifestyle. Now, at the end of those initial 10 years, your loan will not be completely repaid. And that's okay. Thanks to inflation. Because of inflation, it will be an almost certainty that your stock portfolio, your company, and the real estate that you bought, and the ownership in other companies that you bought will all be worth significantly more than when you initially took out that loan. Which means you, my billionaire friend, can refinance it. You can draw more money out using your original stock ownership, which is now worth significantly more, and you can use your real estate portfolio, which is definitely appreciated, as collateral for this new, larger, refinanced loan. You can rinse and repeat this cycle over and over again until you die. As long as inflation keeps ticking along, directly helping your assets increase in value and indirectly helping your company continue to profit by forcing consumers to spend money because they know it will be worth less in the future. Billionaires benefit from inflation. Corporations benefit from inflation. And so does the US government. Why? Well, because the US government is a massive borrower of debt. In fact, the US government cannot function without borrowing debt every single year, because most years it runs a deficit. But again, here's the beauty of inflation for them. Inflation devalues debt by making the dollars borrowed worth less in the future than they were when they were initially borrowed. So this $34 trillion of debt that the US holds is becoming worth less and less with each passing day. And here's the thing. As long as inflation outpaces the long-term interest rate on that debt, the US government can keep borrowing indefinitely for free, because the interest that they pay is less than the devaluation taking place because of inflation, which is why inflation is such a big deal to the government. Not because they care about inflation ruining American lives financially, but because high inflation means higher interest rates, and their infinite borrowing does not work in that scenario. So the sooner that we can get back to 2% inflation, the sooner the Fed will cut interest rates likely to below that 2% target. And the US government can continue to borrow to infinitum instead of actually trying to figure out how to balance the budget, kicking the can further and further down the road. Now, to you or me, it might seem easier to just balance the budget, but to the government, with very influential contractors, donors, and businesses that sell directly to that government, balancing the budget means less money to them, which is why lobbying is such a big business. Now that is probably discussion for another video, or perhaps it's discussion for another channel, because this channel is a finance and economics channel, not a political one. Although unfortunately, nowadays, the line between the two seems to be getting more and more blurred.